Hi Ankita, can you hear me?
Yeah, hi Neil, can hear you very well.
Awesome.
Hi, Ankita. Just can you check once if you can share your screen?
All right, let me do it now. Yeah, you can see your screen,
Yeah.
right?
Perfect. Perfect.
All right, perfect.
Yeah, I'll test mine also there.
Here. Yes, it's good.
Hello everyone, we'll start in 5 minutes. So while we're waiting, if you guys just want to tell us in the comments where you are joining from, whether you already do diversify outside India, just give us some um, background as well so that we can tailor the conversation more towards what you're looking for. Hello everyone. So we will start in 5 minutes, as I said. While we are waiting, do share where you're joining from and if you already invest outside. If so, what percent of your portfolio? That way, we're able to tailor the conversation more towards where you're at and what you're looking for.
Hi Neil, this is Sudeep.
Hi, Sudeep. We'll start in 5 minutes.
Yeah,
For now,
yeah. No, you said if you want to share something for you
sure.
to tailor the conversation, if you want, I can just make a few pointers.
Uh, Sudeep, if you
Hmm.
don't mind, we will open it up as
Yeah,
soon as we're done with I'll keep the presentation
yeah,
part bare minimum. Right
yeah.
now, just inviting it in the comments.
Oh, okay, 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 okay. Sure.
Thanks. All right, I think we can start. Time is precious and we shouldn't take too long. Um, some people may wait for dinner, so we should now start. So, folks, the sense I'm getting is that some of you already do invest and diversify abroad. So, I'll spend more time on the how of it because that is as complex as the why of it. And with that, we'll just begin. Um, I'll quickly introduce Ankita Pathak, who's fund advisor of Ionic Wealth, Ionic Asset Management. It's a AIF located in Gift City that invests around the world. Ankita will talk about the Ionic Fund shortly, but maybe you want to say a quick hello, Ankita.
Hi. Good evening, everyone. Thanks for taking our time, Monday, 8 p.m. I look forward. I'm just reading the chat and I'm seeing a lot of diversified interest from Canadian mining stocks to everything. So I look forward to picking those up as we progress to Q&A part of this.
Yes, and you can direct your investment related queries to Ankita about different markets, different stocks. I will focus more on the procedural parts of the queries. So I'll just share my screen. Can everyone see my screen? Ankita, is it visible?
Yes, Neil, we can see.
Okay, brilliant. So the session today is about global investing for Indians, and many of you are already global investors. So I won't spend too much on the why. For me, there are two main reasons why. One is, of course, currency depreciation. And as many of you would have seen the viral WhatsApp forwards about 1 rupee equal to $1. The truth is that 1 rupee was equal to, sorry, 3.32 rupees were equal to $1 in 1947. And the rupee has depreciated ever since. I have often asked this quiz question when I talk about this, but if any of you know which year the rupee fell the most against the dollar, please put it in the comments. I'll give you guys maybe 20 seconds to put that and I'll reveal the answer. So the question is, which year did the rupee fall the most against the dollar? So the answer, many of you would say 91, many of you would say uh, other years, 2013 maybe, and both of those were depreciation years. But the biggest fall actually was in 1966 after the Indo-Pak War, and the rupee fell by a whopping 56%. So this is the Times of India headline on that day. They've said 36.5% because they calculated it uh, a bit wrongly with the wrong denominator. But if you see the movement, it was a 56% devaluation. And that has every year hurt purely domestic investors and helped those who have international exposure. Now, of course, many of you might feel the dollar is overvalued and the dollar has peaked out, and which is I want to sort of very clearly stress that international is not just about US and not just about the dollar, but rupee weakness has been a persistent theme, and that is what we are all trying to safeguard against by investing globally. This is my favorite chart for global investing because it tells you the rise and fall of markets. So if you see the world stock market as a pie, you would see the decline of some markets, the rise of others. So Great Britain, for example, in 1900 was 24% of the world pie, and it's currently 3%. The US was 15%, and it has risen for most of its history, except for the 1980s. And that's because Japan had a huge stock market bubble and it took share from the US in the 1980s. But the Japanese bubble burst, and we all know the lost decades in Japan in 1990s and 2000s, all the way till Abenomics in 2012. And the US took back its market share, and some argue that the US now looks kind of overvalued. There are other markets waiting in the wings. We don't know. There are many possibilities, but what is clear is no one market always dominates. Um, some of you might wonder, where is India in all this? It's too small to be represented on this global pie. And that reminds us that we are mostly invested in a global small cap, which is quite risky. Now,
Just need
to
one
the
second. Can you just hide that stop screen wala notification toggle on your screen?
sorry, what do I need to hide?
Yeah, this one. Hide one. If you can click on the hide button, that's locking the PPT. Yeah. Cool.
All right. Should I go back, or this slide is fine?
No, this fine. This works.
Okay, so I've made it full screen now. So let's talk about the how of it. We've historically had multiple routes. There is the mutual fund industry route, which is the most convenient one. We've got the liberalized remittance scheme, which has been there for a long time. The LRS limit has fluctuated, but it's been stable at that $2.5 lakh limit for many years now. And there is now the gift city route, which is the third option, technically part of LRS, but there are certain relaxations given to gift city. So in a sense, it is also a third route. Um, I won't spend too much time on this. Many of you would know this fund, Motilal Oswal. Nasdaq launched in what I would say was a visionary moment in 2011, and the return since then has been absolutely spectacular. 23% CAGR, beating everything, including most domestic small cap funds. Almost nothing has done as well. Anyone who's invested in this fund early on would have massively benefited. The counter example is HSBC Brazil, because that has lost value over time, return since launch minus 1.85%, which means that global investing is also tricky. It is beneficial, but you have to get your timing right with the market and the stock. Brazil, incidentally, has rallied massively in the past year. So, after long periods of underperformance, things can switch around quite fast. What if you invested in both? What if you didn't know which would outperform? A basket approach would have actually given you a pretty decent CAGR of 17%, because Nasdaq would have more than compensated for Brazil underperforming, and more than the Nifty CAGR also. In fact, more than a combination of Nifty and small cap. But the point here is not to beat the domestic market in returns at all points, but to diversify. So to do, as Saurabh Mukherjee once put it, kahin pe to it's morning and the same time it's night. When your portfolio is spread out, one thing does badly, but the other part does well. And that's the greater benefit of global investing. This is the most scientific indicator of why you do well by investing globally. So this is what would have happened to the Sharpe ratio if you had been a investor in these geographies in most of the countries around the world. And you see that the Sharpe ratio actually improves if you invest globally. Now, the routes to global investing. So as I said, the easiest one, most convenient one is mutual fund, which is either a feeder fund or you do a combination of domestic and international stocks. So, for example, a pure feeder fund would be, let's say, a Motilal Oswal Nasdaq, whereas a combination fund would be a Parag Parikh FlexiCap. And the feeder funds, most of them are shut because of the RBI limit that came into effect in Feb 2022. Some of them are open, and we have recently put out a list of ones which are open. The reason is that there are unutilized, very small unutilized AMC limits, and those limits also open up time and time again because there are redemptions in some of these funds. but it's not a great way to invest because they open and shut, and you can't reliably do a SIP in them for a long term. The other option is direct investment via foreign brokerage like Interactive Brokers. Third option, which is kind of almost the same as the second one, the only difference is that some fintechs are essentially Indian fintechs. And the benefit of that is that they provide certain tailored reports to Indian users, such as tax reports. But otherwise, they plug into the same pipelines of international of brokers located abroad, like Drive Wealth. And the fourth, as I said, is through a Gift City fund. And we've seen the first Gift City outbound retail fund, which is DSP emerging. There are other AIFs also. There are many AIFs which allocate globally. Ankita represents one of them, so she'll talk more about Ionic asset management. But there is a number of options now for in Gift City for outbound investing. As I said before, mutual funds have hit the RBI cap. Some do remain open, either because they have a mixture of Indian and foreign stocks, so the fresh money goes into Indian stocks. But that's again not ideal because it just leads to dilution of the foreign exposure over time. So again, Parag Parikh has gone from 35% outside India to just 10% outside India at present. And with the feeder funds, they open and shut depending on redemption. So you can't do a long-term SIP in them. Now, how about investing via brokers? Fairly convenient. Many of them, like Interactive, have offices in India. Not many, actually, just a few, but Interactive is one of them. Um, and you can put up to $2.5 lakh every year under LRS. Above $10,000, there is a tax calculated source of 20%, but you can offset that against your advanced tax liability. So it's just a collection of tax. It's not a fresh tax that's imposed on you. Via fintechs is almost the same as the first option, which is the broker option. But the benefit is that they provide India-specific reports for tax filing, and that really helps with things like Schedule FA. Gift City, I would say, is an option in itself because of certain relaxations. So the biggest benefit is that you have familiar names in Gift City. They're accountable to an Indian regulator, IFSCA, and most of them are AIFs. They have a minimum ticket size of $1.5 lakh. But if you become an accredited investor, you can put in as little as $10,000. And Ankita might elaborate a bit on that because they have given the facility to accredited investors at Ionic. But it certainly lowers your ticket size quite a bit. Of course, you have to prove certain criteria to become accredited, like net worth above USD 1 million. The first retail fund was launched in Gift City by DSP. Minimum ticket size of just $5,000. Invests in markets around the world like US, Europe, Japan, etc. One peculiarity here is that the tax is paid at fund level. So it's unlike Indian mutual funds where tax is paid by you when you redeem. In this case, tax is paid by the fund when it does churn, and the tax is really high when it churns in the first 2 years. So I'm hoping that DSP will minimize any churn in the first 2 years. After that, it's 12.5%, which is standard for domestic stocks as well. So when you redeem, you don't pay any tax because the NAV you get is net of tax. Do remember that. This is an infographic that we did at Mint when I was at Mint about the DSP launch. It gives a detailed breakup of where it invests, what kind of companies it invests in, companies which are above 30 billion in market cap. It is country agnostic, aims for minimum 6 to 7% earnings growth. There's a lot of detail to unpack here. We'll send you the presentation afterwards so you can see this calmly and study it in a bit more detail. For those of you who want the most convenient route of Indian feeder funds, here's a list of feeder funds which are currently open and accepting money. As you would see, they cover diverse markets from Europe, US, China as well. So there's a reasonably good selection, but as I said before, these are small limits and many of these will shut as soon as they are filled up. So with that, I conclude my presentation. We can hand it over to Ankita and we will get after that straight to the questions.
Super. Thanks, guys, and thanks, Neil, for setting up the context very, very beautifully. So let me just quickly start, and hopefully, in interest of time, keep it extremely short. But Neil's made a very good few points. Let me just add to it. India currently is about 3% of the market cap. The number you'll probably hear is about 3% or 4%, depending on which year the data was calculated. But the point is that at either of the percentage, global market cap is 109 trillion, of which only 4.5 trillion is India. So the remaining part of the world is left, which India is not able to participate. And India has done very, very well. I wouldn't deny that, about 90 odd multi-baggers were formed in India. But let's be honest, around 1,400 were formed outside India. So there is an opportunity size that Indian investors have not been traditionally exposed to, which is changing now. So, your MF limits are exhausted, AIF limits are exhausted, LRS limits of ultra rich are exhausted. OPI, through which companies can take in a bigger amount, is seeing a long queue. And just as a matter of fact, India did 13 billion in LRS in 21, and that number went up to 32 billion in 2024. This goes on to show already that this 2.5 times jump that we've seen in LRS shows the willingness of Indians to actually explore offshore opportunities. Now, why would you do that? Reason one, your return tends to be higher. So just take 100% India portfolio, which is this line. So 0% here shows zero global equity, and then just keep diversifying this all through, and then you will see that if you're 50 India, 50 offshore, over a 10-year period you have 3% extra return CAGR, and the number does hold true across time period and across levels of diversification, meaning you can start by diversifying 2%, 5%, 10% of your equity portfolio. Any start is probably a good start. And at the same time, risk gets reduced. So if you look at standard deviation of MSCI India, it's about 26 odd percent. Of a global index is about 14 odd percent. So, when those extreme market events do happen, you end up falling less. The investment experience is smoother, and if all of us have read like Morgenhauser like we have, I think that is one big reason to stay invested in the market. If your investor journey itself allows you the privilege of compounding. Second, the next set of multi-baggers are not available in India. We are definitely in an innovation revolution where things like electric batteries, India's market share is less than 2%. Autonomous tech, we're not doing much. IC design, etc., we are barely present. So some of these themes is where you're still getting 20% kind of a sales growth, very good financials. There is a clear sign that if you catch them young today, they'll probably make into something solid, if I don't use the word multi-bagger per se, over time. And then you need to participate today, but unfortunately they're not really available in India. Like for an Nvidia, we barely have maybe anything that's comparable, but we've tried to put the lowest hanging fruit, and even then the difference in revenue, the difference in market cap, etc., is of 1,000 times, if not more. Third, let's never confuse GDP growth with market correlation. Okay, India can continue to be the fastest growing economy in the world. I'm super long India, and I think it will happen, but it doesn't mean it will generate the most shareholder returns. So between 2010 and 24, India's GDP went up by 2.3 times. India's shareholder returns went up by 4 times. US's GDP went up by 1.9 times. US's returns went up by 12 times. So 2.3 is less than 1.9. But here comes your 3 times more market returns. And Japan's GDP actually fell by 0.7. There's a decline, but still market growth was solid. So don't don't, and despite being a trained economist, I would say that most of us, uh, take macros and markets like to like. It's not true. India in the last decade has grown at about 6-7 odd percent. The CAGR return on in NSE would be closer to 12 odd percent. US, on the other hand, has grown at 2% GDP wise, but the returns are closer to 16 odd percent. So lower GDP growth, higher market share, higher market cap growth, and higher shareholder value is pretty much possible. As we stand today, of course, India, 1 year returns, India is the worst performing market. So if you've been, in any of these names, returns would have been looking very, very palatable. Innovation should be about profitability, not, the buzz, jazz, AI bubble, nothing like that. If the numbers are not good, you should not invest in a theme. That's 101 of investing. Innovation as a theme, earnings CAGR. Okay, this is not price. Earnings CAGR stands close to 25%. S&P 500 is 10%. So this bubble is actually justified and really really backed by earnings, which is where the option to going offshore remains. So those are the fourth reason, and the fifth reason is that building dollar assets is invaluable. At some point people used to build it for kids education, then came property abroad, then came migration. We hear Dubai flats, we hear AB5, but there are also unknowns like medical emergency, geopolitics, etc. So in that sense, diversification is always a good option. So that is our 5 reasons as to why go global. I would quickly spend a minute as to why people still don't do it as much as they would like to. And mostly the answer we get is like, we don't understand the space. There is no research available. In one of the seminars, I found it quite funny, but someone said, the way I invest in equity markets is like asking my friends and my neighbors, and we all do the same thing, but my neighbors don't understand what NVIDIA does. So how do I build conviction? I think that is where, managers like us come to picture. The Ionic vision was always to solve for this problem. We understand that, if you're doing investing has to be about first principles. So if you look at all global tech companies, about 6,500 of them, only 3,000 are profitable. So we don't care about the 3,500 which are not. Filter it over higher margins of about 40% plus, ROE of 10 or higher than 10, but current fund ROE is closer than 25. Sound valuations, fund forward P is still about 22 times. If I remove my top 2-3 high growth name, it will fall closer to 19 and a half. We reach to a universe of 100. There we create a portfolio of 30. 5, technically, the idea is to have moated business, the ones which have strength, competitive advantage. They have operating efficiency, but the valuations are cheap and earnings are positive. We, of course, have established, a tie-up, but I think I will take these questions later. This is how the portfolio analytics looks like. It's 40 US, 30 East Asia. So there you have China, Taiwan, Korea, 15 Europe, 5 LATAM, and 10 cash. This is how we are positioned today. And the fund's pretty much live. But I think in interest of time, I'll take a pause right here and I'll go on to the Q&A, and then whatever part that interests us most, I'm happy to deep dive into.
Fantastic. So what I would suggest is, because Ankita is on a very tight deadline, let's take up the investment related questions first. So if you guys have any questions about which market to invest in, how to pick global companies, send them now. Once they are done, I will address all the procedural questions about LRS, tax, remittance. Leave that a bit later. Right now, please focus on the investment side of it. So Dhairya, if you can read. So folks, again, in the interest of time, please type your questions. We'll take them on a first come, first serve basis. And as I said, we'll first take the investment related questions, which Ankita can answer, and then the procedural related questions, which I will answer.
Yeah, so we have one question from Dibyendu. Considering the recent years underperformance of FTUS Opportunities Fund, even the era of AI tech boom, how can one mitigate that risk? Your expert view would be much helpful.
Sorry, which index is this?
FTUS Opportunities Fund.
This is the Franklin Templeton US Opportunities Fund that was launched in 2012, I think.
Okay, I mean, I'll have to look into the specific fund, but see, underperformance versus a global index or underperformance versus your best other alternative of investing, which is probably a Nifty, etc., is something that you have to take in relatively. So that's one. Like, how are you comparing it? Are you comparing it to underperformance to Nasdaq? Maybe it's an active manager. They've taken some calls. It may not have worked out immediately. It's pretty much possible. But has it helped you diversify? I think that remains the bigger chunk of the question. Having said that, it's a fund from a fund house that I've not really studied, so I'm not sure what the manager has bought of late.
Yeah. So there's one more question. Can you share a geographic breakdown of your portfolio?
Yes, I did mention on the presentation. Right now, it's 40 US, 30 East Asia, 15 Europe, 5 Latin America, and 10 is a conscious cash call.
So I think the rest of the questions looks more procedural. Just a second.
I think there are.
Yeah, I think they're all procedural questions.
There are a bunch of these questions. So let me just take, one on.
My question is, the CAGR you mentioned about 100% India and 50-50 is net of taxes?
It's net of taxes, yes. And anyway, just for FYI, whether you do a gift city fund or a domestic fund, after 2 years, you're subjected to the same long-term capital gain tax, which is 12.5%. So there is no difference. The difference only is in the short-term taxation.
Yeah. So there's one question from Vivek. Given that global indexes have thousands of stocks, will having only 35 stocks in AIF be too concentrated?
Not really, because the idea of active management is to filter out, the sound from the noise. So while indices will have and that's why indices sometimes tend to be overly diversified. Choosing high concentration bets, I think at 35 looks like a decent number to us. Between 30 and 35, I think we've been able to do top 10 at about 52%, and then have a tail for the remaining 48 odd percent. And in the current macro regime, it does work well.
Yeah. So someone is asking with regards to reasons behind the geographic breakdown of what you mentioned before.
Sure. So geographical breakdown is a function of 4 factors: the macros of the geography, the earnings, the valuations, and the flows expected. Now, while US has continued to lead the world as far as the market cap is concerned, it is cognizant that there is some bubble building there. Some parts of the US markets have become very, very expensive. There is a rotation happening from large cap to small end, mid cap, from growth to value, while we see it. So while, US has just pockets of opportunity, when the de-dollarization happens, and if Fed was to cut rates, it is the emerging market basket that tends to benefit. And when FIs go out hunting for emerging markets, the cheap emerging markets such as China, Korea, trading at like 12 times forward PE, gets an innate advantage over India, which is almost at the same forward PE as US. And these are the economies which will do very, very well. So 40% US quality, and the remaining, a diversified portfolio is where we find comfort. And it's purely based on the framework, as I said, on macros, earnings, valuations, and flows, to be able to deploy in these geographies.
Yeah. So there's an interesting question from Aditya. Request you to advise how do we assess which geographies to invest?
Sure. I mean, Partly you could use the same framework as me, maybe go on to Bloomberg or whatever database you use, build in your sheets on what's happening in macros, what's the government advising, what is happening on monetary policy, inflation, growth, what's changing, fiscal reforms, or like something like South Korea where tax rebate has been along tax capital tax that was coming has today been pulled away. So start tracking those news, and that would fall the macro component. Track the earnings, track where the market is, what's the forward valuation, where is it compared to history, and where is it compared to its other peers. And then, of course, what can bring in the flows in the market? Is it like, like I said, because other emerging markets are so expensive, that the cheap emerging markets of China and Korea have recently gotten all the flows. So, what could change for them? So if you can build substantial amount of data around this, I think it will start speaking to you. I would always say that, if your full-time job is something else, maybe outsourcing it to a manager or through a structure would make more sense, because they'd be able to, run the rigor for you 24/7.
So this question from Prachi. Globally, usually tech has always been doing well. Is this true? Which other sectors globally can be looked at?
The tech's always been doing well, and I was saying, no matter how much we talk about the bubble, the tech is really backed by earnings. Like even this season, in 100% of tech, I think 80 is the story, 20 is the bubble. Even in this season, we saw, Microsoft, Meta do really, really well as far as their earnings were concerned, and even the smaller tech names. So 100% backed by earnings, continues to do well. So there is that. Now, which other sectors you could look at? You could possibly look at what's happening in the EV space in China. You can look at what's happening in the digital advertising space, mobility space. I think some of those sectors are also seeing a rebound after sluggish last few quarters. But this is a dynamic answer. So while tech has been a one way upwards, at least in hindsight, some of these sectors could come in flavor as demand exceeds supply, then die down as earnings don't point out. So slightly more cyclical in nature, but definitely worth looking at to diversify from core tech.
Yeah. So the other question is, what is the sector allocation? Which sector has the highest exposure?
I think the highest exposure would probably still be with semiconductors at about 25%. Sector allocation wise, we are fairly diversified. No sector holds more than 40%, but we would be between semiconductors, mobility, application software, hardware, somewhere around 15 or 20% in these sectors each.
So the other is, how will you mitigate the risk from de-dollarization trend when the world moves away from USD as the reserve currency?
Sure, good question. Okay, so let's just get the currency part right. Okay, when we invest offshore, there is a cake and there's a cherry on the cake. Okay, your cherry on the cake is the money that you will make because INR depreciates at 3.5%. It has done so. If you just stagger out 20 years of our lives, so that 3.5% is the cherry on the cake, the money that you will make that I don't work for. Basically, it's the nature of the Indian economy that gives you that cherry. Now, the cake is the part that I work for. I work for maximizing the total returns. I work, the investment strategy about how do you go and build money into it, right? When de-dollarization happened, and I said it at the start, emerging markets tend to do very, very well. Europe tends to do very, very well. So if in that cake, 70% is emerging markets and Europe, etc., the returns would be so good that the cake itself will go on the size. Maybe you will not make that much on the cherry. Maybe your cherry will be smaller, but the cake itself will grow on the size. So de-dollarization is good for two reasons. It's good for emerging markets, LATAM, East Asia, Europe kind of a portfolio. Second, because all American companies, at least the big ones, are MNCs, this essentially means they're exporters of their services. When dollar weakens, their earnings tend to go up, right? And because of that earnings surprise, markets tend to eventually begin. So there, that part of the portfolio also does well. So uh, cake grows bigger, cherry probably smaller. I don't think so that Indian rupee can appreciate meaningfully over a 3-year period. We could have that 3, 4, 5, 6 months of appreciation. It's 88 something today. It could probably, go to 87, 86. But there is a downward bias to currency. Why? Because we are not having FII flows, we are not having FDI come in, services exposure is not picking up well. And RBI in every dollar weakening cycle in history has built up forex reserves than to allow INR to appreciate. We want to stay competitive in the global exports market, especially in the tariff situation. This becomes even more relevant, right? So, two parts to that answer. One is on the portfolio itself, which is, as I said, that because other markets do better, actually the cake grows. Second, cherry becomes smaller. Cherry doesn't stops existing, or cherry doesn't start, going in the cake, which essentially means to say that rupee most likely over a 3-year period will still depreciate. Maybe instead of 3.5, it can depreciate by 2.5% but you'll still have that cherry, but you'll have a bigger cake. Now, third meaning to that question is that, dollar loses its reserve assets and, gold becomes a new currency. I think that's not happening in the here and now. There, even if that some of these subtle trends start, it will probably take about 2 to 3 decades, certain laws, etc., to be passed. Where we stand today, I think dollar is pretty much the reserve currency, and we are all pegged against it, and so is the fine.
So the next question is, hasn't the market prepaid too much for that future with tech market cap at $28 trillion and share of tech at 30%? Is reminiscent of 2000 tech bubble?
Sure, and this has been going on, as managers, when we look at these top numbers, of course, it brings in a tech bubble kind of a feeling even to us. So point taken there, but if you dig down into smaller and mid cap names, the data of which we don't hear back in India that often. If I tell you the S&P 400 and S&P 600, which is the mid and the small cap indices of US, are trading at a forward PE of 16 versus these top 10 tech companies at 30. It's literally half the PE. So there is space available, and that's where maybe passive investing doesn't solve for it, but active investing and looking for these valuation comfort actually solves for it. Knowing on tech bubble, I just have, a thought which I thought is worth sharing, which is that, um, the rumors of tech bubble are probably not new, and we've not seen the bubble burst. I'm not saying that the bubble itself is resilient. I think the bubble will burst. But until the time the data changes, which is either the earnings stop being good or the incremental spend that is happening and incremental adoption that is happening in this space slows down, I think calling off a bubble and not being able to participate when this theme itself has given a CAGR of 20% in last 5 years, as an investor would not be the wisest thing to do. So how will I create a portfolio? In my head will probably be looking for pockets of opportunity where it does not feel like a bubble because the valuations are still under the control, and PEG ratios, which is price to earnings growth ratio, I can still get it closer to 0.7, 0.6. I will probably put in more work to participate in those opportunity than to look at the index and worry about the bubble, because in the second way of investing, I know where I'm building conviction per se.
Yeah, so I think so. These are the questions regarding yours. Rest mostly are something in the direction of how to invest and expense ratio and everything.
Sure, I'm around for a bit, so Neil could probably take them up. Anything that
Ankita, you want to quickly address? There was one question on China, I think, and one on expense ratio. So both are specific to Ankita
Sure.
domain.
What's the question in China again, please?
Yeah, sure. Just a second.
Meanwhile, expense ratio is fairly simple. It's a graded expense ratio. For a minimum ticket size, it's 1.75. For 500K, it becomes 1.5. For 1 mil, it becomes 1.25. So it's pretty graded based on corpus of investing. But if there is any specific query you all have about the fund and of course on these lines, then we are at gift@ionic.in.
Yeah. So the question is option to take exposure to markets apart from US like China, LATAM, etc. I think so
Uh,
they want to understand more about exposures to other market.
sure.
No, the question that I was referring to is there was something about political risk in China, that what if things change? So because I think Ankita addressed the question about diversification as to why they are in which all markets, but Ankita, just very quickly on the China political risk, and there's one on accredited investors, the expense ratio for them.
Sure. So China political risk, I mean, is something that we account for by actually diversifying, but also just from financial standpoint. I mean, we went positive China last September. Last September to now, we've been big China bulls. We've been seeing the value. We've been seeing the turnaround happening from manufacturing to exports, and then a big lull period, and then uh, you know now taking stance on consumption and technology, and then doing it with sovereignty. So, while we talk about all American cloud providers, and after Oracle, everyone knows what cloud is. The only company in China that is, the biggest player is probably like Alibaba, because it makes cloud for these Chinese AIs that will come in per se. So that is China at the intersection of consumption and technology is something that we like. Now, having said that, like everything in investing, right? So everything in investing will feel like, this is a tech bubble, there's a political problem, this will not be right, this will burst, this is not the space I understand. Some of this, in my personal opinion, could probably also be coming from, our unfamiliarity with that space. So if in India, markets have not delivered for a year and most investors are comfortable with it. But if a market that you do not understand or do not know falls by a percentage or two, it does give people a lot more worries per se. And I think that unfamiliarity has to be solved for. How we did it at Ionic is that, we tied up with a research house called New Street Research. They have offices in US, UK, Hong Kong, Singapore. Their analysts are in the location. So for my China, calls, I speak to an analyst in Beijing who spent 25 years at Bernstein, now works with NSR. So some of these, myths are busted. You can actually delve into the data that is they are publishing. Some of the things are actually published in a different language, as will always be true for global investing. So some of that expert research helps us, basically carve out what's the fear of unfamiliarity and what is the reality of having discovered that data. On
Ankita, do you want to very quickly mention how you hired analysts in your own team? I think it's a interesting precedent that other funds might also follow.
I think so. I think I'll be responsible for the salary hikes in that space. So I think for my own team, and even if I ever add team at Ionic also, I think we were very clear that we did not want to make a small cap analyst do global equities from tomorrow. Saying, you've been watching paint, cement, and textiles. Now start watching EV. We felt these are two very, very different themes. And therefore, our internal team is hired from an international bank itself, and the team was reporting to managers in New York already. So these people, for the majority of their career, have done just global equity research. They've never looked at Indian capital markets. They are the people who've been looking at tech, software, uh, you know, EVs, digital media, these kinds of sectors. So they bring in that expertise in-house, and that plus News Street does help us familiarize ourselves from newspaper narratives that we all succumb to sometimes.
Yeah. So the reason why I think this is interesting on a broader level is that we have so many Indians sitting in India analyzing global markets for global banks and for global brokerages. And now, for the first time, they can turn their skills to the advantage of Indian investors, their own countrymen. So I really hope that this trend catches on. We have a talent pool that already exists that works for global names. All right, Ankita, on that note, last question on accredited investors and their expense
It's
ratio.
2% expense ratio for accredited investor.
Yeah, so the reason why it is on the higher end of the range she mentioned is because the $10,000 ticket size. So if you increase the ticket size, they bring down the expense ratio. That's the graded system that they follow. Um, okay, so with that, let me now turn to the many
Thanks,
procedures.
guys. I think Neil's still around. We'll take up all the questions that you all may have. Thank you.
Thank you so much, Ankita. So on that note, let's proceed to all of the many procedural questions that we have. Daria, can you take me through them? Sorry, you're on mute, Daria.
So first question is from Lawson. Parag Parikh FlexiCap Fund has overseas investments. How it will be helpful by investing in a mutual fund via Gift City? Any taxation benefits as compared to FlexiCap? Will the tax paid by the fund reduce our units account accumulated in the fund? And the last question is the expense ratio exit load less as compared to FlexiCap?
Okay, so Parag Parikh FlexiCap has a mixture of global and domestic stocks. The global exposure has come down from 35% to 10% because of the RBI limit. Parag Parikh FlexiCap is taxed as an equity fund in India, so 12.5% long-term capital gains tax after a year. Now, I think the question is what happens when they launch a Gift City fund. And by the way, they are already testing out their Gift City offerings in beta version. So what will happen is that you can invest in them through LRS. The taxation after 2 years is the same, 12.5%. Before 2 years, you will be taxed at slab rate. Above $10,000, there'll be a TCS tax calculator source, but you can offset it against advanced tax. The benefit of Gift City is from a tax reporting standpoint. So when you directly invest abroad, you have to make sure the Schedule FA is correctly filled, and it can be quite complicated. In case of Gift City, it's inside India from income tax purposes. Therefore, that aspect does not come into play. Next one.
Yeah. So the next question is, how does LRX works? Are there any charges?
A liberalized remittance scheme of the RBI. So you can remit any amount up to $2.5 lakh every year. The charges are dependent on the bank. So the charges is essentially the currency spread. The bank might buy dollars at a particular rate, sell dollars at a different rate. And there's a gap, which is the spread. Now, if you are sending out higher amounts, you can negotiate with the bank to lower the spread. Most banks will lower the spread. That is the only charge. Apart from that, as I said, there is a TCS, but that's TDS essentially, as you can adjust that tax against your advanced tax liability, or you can get a refund.
So next question is from Aditya. Request you to advise the difference in detail, please, between investing directly through foreign brokers, example Interactive Brokers, versus Indian fintechs, example Vested and Money. Kindly elaborate on safety aspects similar to what DICGC of India does for depositors and taxation aspects.
Sure. Okay, so there are multiple differences. Probably the biggest one is on how Indian fintechs can tailor their reporting to Indian tax, right? Schedule FA is quite complicated. They just provide a pre-filled form that you can send to your CA and use it to fill the return. Apart from this, there is more accountability because they have employees and offices in India. And by the way, there's a third player which I haven't mentioned. So I've talked about Vested in Money quite a bit, but there is also India INX, which is a BSC subsidiary, a subsidiary of the exchange, the stock exchange. So that's still more accountable, and you can invest through that also. Other advantages. So some of these fintechs are getting registered with IFSCA, the gift free regulator, which means you have recourse if something happens. And in fact, I've just tweeted about how IFSCA has told one of the fintechs, Vested, that they cannot offer Bitcoin ETFs to those through LRS, those who want to diversify abroad, because there are strict rules about what you can buy under LRS. So you have that confidence of an Indian regulator in charge, who has, who can exercise supervision on these fintechs. In terms of DICGC, so US has a deposit guarantee up to $500,000. I forget the technical term for it, but they do have that backup if a broker in the US ever fails. I have not heard of a broker failing, but in case that happens, that it kicks in.
So next question is from Mohit. How capital gain works in case of gift city to an Indian? Is there double taxation? One is at the fund level and another at the individual.
Okay, so capital gain up to 2 years slab rate, short-term capital gains after 2 years 12.5%. The only difference between an Indian domestic stock is the time period. It goes from 1 year to 2 years, which is fine. You're supposed to hold equity for at least 5 years anyway. What was the other question? Part of the question?
Is there double taxation?
Double. Okay. So the reason why it's confusing is because of how DSB's retail fund is structured, where the taxation is at fund level. So the NAV you're getting is after accounting for that tax deduction. But it's not double because when you redeem from the fund, that amount is tax-free in your hands because the fund has already paid tax at its level on your gains. So it's not double. There you go.
Yeah. So the next is what is the tax? I think so. This is answered. Okay. So the next is what we have answered this indirectly, but we can cover. What are the risk? What are the risk in investing between directly through foreign brokers versus Indian fintechs? Someone said that there is risk of latter going bankrupt, and our capital is under the name of Indian fintech, not our own name. Is it true?
No, I would not say that. I mean, of course, any broker can go bankrupt in any jurisdiction, but they are under the US SEC, so chances of it are low. And Indian fintechs, by the way, also plug into US brokers at the back end, so that risk is equally there with them. One benefit of investing in a gift city fund is because your units are held in gift city and not in the US, you are not subject to US estate tax. So in case of either the foreign brokers or the Indian fintechs, your money is ultimately held with a US broker, and if you pass away, unfortunately, and your holding is more than $60,000, then they will deduct estate tax before giving you the proceeds. That risk goes away when you invest in a gift city fund, even though the money is ultimately invested into US or other stocks because it's through that fund structure.
So next question is, what is the minimum ticket size for investing in your gift fund? Can resident individual invest in it and taxation angle?
So this might be directed to Ankita, but I will try to answer this in a more general way. Minimum ticket size for an AIF in Gift City is $1.5 lakh. If you are an accredited investor, that comes down to as low as the fund wants it to be. So in Ionic's case, it's $10,000. Other funds might stipulate a lower limit. To get accredited, you have to have a net worth of $1 million, 9 crore rupees. Half of that must be financial assets. And by the way, there's also a retail fund investing overseas, DSP. It's the first. There'll be many others. So this amount will keep coming down. Don't worry too much about the ticket size.
So the next question, I think so, is more relevant for something like DSP. What is the minimum ticket size for investment and platform to invest?
DSP minimum ticket size is $5,000. Platform to invest, you can go onto the website of DSP IFSC, which is their IFSCA branch. They have an offline route where there's some amount of form filling. They have also done some online tie-ups. Perhaps the easiest way to do it, the most conflict-free way of eventually doing it would be through the India INX exchange. Right now, it's not on India INX, the BSE subsidiary, but give it some time. Let more funds come. All of these pipelines will get activated. For now, you do have the offline option where you can connect with DSP and fill up the physical form.
So the next question is from Karanvit Singh. It's a three-part question. Part one, how does Gift City differs from a mutual fund? Part two, what is the minimum investment? And part three is any takeaways or quick guides for those coming from purely mutual fund investment backgrounds.
So Gift City is an SEZ, a special economic zone. Think of it like India, Singapore, or Hong Kong. It's just a place where mutual funds and AIFs can locate themselves in a tax efficient manner and in a manner that is outside India's foreign exchange regulations. So Gift City is, although physically inside India, it is outside India from a FEMA point of view. So it's different from mutual funds because mutual funds are very much onshore vehicles. They are subject to the RBI limits on overseas investments. Once your money goes into Gift City, there are no more restrictions. You can invest that money in whatever stocks, funds you want to. Um, it will look more and more like Indian mutual funds as more of these come up. Right now, it sounds kind of strange and unfamiliar, but it just needs a bit of study. If you're in Gujarat or if you ever go to Ahmedabad, please actually physically visit. It's not that far. I'm going there on Thursday, looking forward to it quite a bit. And you can talk to some of the fund managers there. It's quite interesting.
So next question is from Kaushik. If I invested in overseas market through brokers such as Vested, does the investor get benefit of USD INR appreciation? Do the same benefits accrue through mutual funds or ETFs such as Motilal Oswal Nasdaq 100?
Yes, it accrues both ways. So in either case, the ultimate investments are in dollar assets. So whether you invest through Motilal or through Vested, you still get the benefit of the dollar going up against the rupee.
So the investment threshold of $150,000 is too high for investing via DSP Gift City. Does the same limit applies to Ionic AMC? If yes, what are the other ways to get exposure to other markets?
So there's some confusion here. DSP has a $5,000 ticket size, not 1.5 lakh dollars. All the others have 1.5 lakh dollars because they are AIFs. Even an Indian AIF has 1 crore rupee as the minimum ticket size. Now, how is Ionic doing it differently? So Ionic is saying that if you are an accredited investor, we will lower that $1.5 lakh ticket size to just $10,000. So that is the minimum limit there.
So next is there a way to invest in US ETF so that dividend gets reinvested, not returned to investors? This will help in driving growth and avoiding tax liability till the point of redemption as well.
Yes, there is. So there is something called a UCITS ETF. So this is a kind of ETF that's listed in Europe, and they have something called the accumulating plan. So in this kind of plan, no dividends are declared or paid out. That money is just think of it like the growth option of a mutual fund. That money is just reinvested in the fund. And the other benefit of a UCITS ETF is that it's not subject to US estate tax.
So next question is from Shravan. Is the NAV of Gift City calculated basis the actual tax paid or is it basis forecasted redemption?
Yes. So when you do a redemption, they will do an estimate and pay you the net proceeds. You're right. It does sound complicated. To avoid this complication as much as possible, just avoid redemption in the first 2 years. Anyway, in equity, you should not be investing for less than 5 years.
So next question is from Rajiv. Are there any funds which invest in growing markets instead of US markets?
So yes, there are lots of ETFs in the US which track other emerging markets. So for example, there is an ETF in the US with ticker EWZ, which tracks Brazil, or there's an ETF with ticker EWW, which tracks Mexico, or MCHI, which tracks China. I'm just giving you examples. I'm not recommending any of these ETFs, but through the US, you can access practically any market you want in the world.
Yeah. So next question is from Vivek. Will it be safe to invest in Chinese stocks as investors are not allowed to invest in sectors like tech and we have to go through VIs listed in Hong Kong and elsewhere?
Yes. So Of course, there is always a risk, a political risk, but to deal with that complication, you can invest in stocks listed in Hong Kong, the Hang Seng. In fact, we have a couple of India listed ETFs which track the Hang Seng Bees, for example. So that could be a better option.
So next question is, what if I invest in GIFT fund as an NRI and then become a resident Indian after a year or two? Can I continue to be invested in GIFT City or have to opt out?
No, you can very much continue to be invested in Gift City. There is absolutely no restriction to that. As an NRI, you can invest in inbound funds which invest in India. Now, when you become a resident, what happens to those inbound investments? That is something that we'll have to honestly check, because right now we're talking about outbound, which is investing in markets around the world. That will not change whether you're a resident or NRI. You can access those. Inbound is a bit complex, and we will get back to you on that.
So next is Prashant. Which are the apps which can be used to access US, Japan, European markets, etc.?
There are a number of apps been there for a long time. There is one owned by the BSC, which is called India INX. Probably the most conflict free, in the sense it's practically an exchange which is owning it, a way to access world markets. There is Vested Finance, there is Ind Money. Yeah, there's, I mean, so many of these.
So, okay, so this is from Nemil. Are the regulations in China investor friendly, considering no meaningful judicial system in China? How safe is the investment?
So, as I said, everything comes at a risk, but China has changed quite a bit since a year ago, and since that pessimism, they also recognize that they want foreign investment, they want stability, they want to compete in the world. So, don't write it off, is what I would say.
So next question is from Anudeep. Are performance disclosure standards for gift city funds same as the domestic ones?
They are similar. A lot of the regulation that IFSCA has adopted has come straight from SEBI regulation. So I would not think there's any particular risk there. So I would not worry too much. Many of the IFSCA officials are also ex-SEBI officials, or they are drawn from RBI or some other Indian regulator.
So next is from Prachi. What is the process for investing in IFSCA registered fund? What all accounts need to be opened and with whom?
Yeah, so currently mostly it's offline, because most of them are AIFs, and people, because the ticket size is so high, they fill the forms physically, the application form, then the remittance form, the A2 form to send money to Gift City. Even for DST, the only retail fund so far, there is mostly an offline process where you fill the application form, get your KYC done. Again, unfortunately, even though you have an India KYC, you have to again get a KYC done in Gift. But this pipeline within the next year will most likely go online, and it will get standardized. So don't worry too much about it.
So next is, can HUF invest through Gift City? For example, either using brokers like XYZ or the new MF route?
That is a good question. We will have to get back to you on that.
Next is there any retail inbound Gift City fund available for NRIs?
Yes, soon to be launched, which is why I'm going to Gift City on Thursday. So I will announce it within a couple of days.
Okay, so what is the minimum ticket size in REITs and InvITs through Gift City?
I don't think there are any REITs and InvITs in Gift City. I may be mistaken, but I'm not aware.
Okay, so someone has asked, what is an accredited investor?
An accredited investor, by the way, this concept exists both in India and in Gift City, and tomorrow we are writing a detailed infographic on it. But essentially, it means that you are high net worth, and a CA has certified that you are high net worth, and that unlocks certain things for you. So the minimum ticket size of, I'll take the domestic case first. So to invest in an AIF, you have to put in 1 crore. That goes away. You have to put in 50 lakhs minimum in a PMS in India. That also goes away. In Gift City, again, $1.5 lakh AIF goes away. PMS $75,000 minimum goes away. It unlocks. Think of it like a key that because SEBI is convinced or IFSCA is convinced that you are rich enough, you know what you're doing, it's sophisticated, they do away with a lot of the restrictions that apply to ordinary investors.
So next is currently DSP is the only retail fund. When can we expect timeline others to come in? We can plan our investments accordingly.
Yeah, over the next few months, a lot of these should emerge. Like I said, Parag Parikh is in beta test for its Gift City funds. I know a lot of other AMCs are waiting in queue. So give it a few months.
So next is how much tax does DSP Gift City fund pay at the fund level? If it is registered as a trust, it will be 42% like Cat 3 AIF.
Yeah, that is the unfortunate part, that if it does any churn in the first 2 years, it does pay 42% tax, which is why they are also conscious of it. They don't want to inflict churn and high tax on their investors. So I think it'll be quite minimum, and you as the investor should not redeem in the first 2 years.
Investment in DSP IFSCA fund will amount to foreign assets.
No, so it's a very curious position. So Gift City is outside India from a FEMA point of view, but it's inside India from an income tax point of view. We checked this with a bunch of CAs. And so they said it does not amount to foreign assets for tax purposes, does amount to foreign assets from a FEMA point of view.
So next is from Ashish. Even companies like HDFC Life International are offering through Gift City global investment products. Multiple themes like Nasdaq, emerging economics. Any update on this?
I would not like to touch an insurance policy that combines investment and insurance. We've seen the horror stories in India. I don't think it'll be any different in Gift City, and I think most of them are aimed at NRIs anyway.
So next is from Himanshu. From a taxation perspective, I am at the mercy of the fund to not redeem before 2 years to avoid paying higher tax.
Mercy, as in they are also conscious of the fact that any churn will drag down the NAV. So I don't think they have any interest in inflicting a 42% tax on anyone.
So next is if there is an NRI investing in India from a zero tax structure country like Oman via NRE account and now wants to realize his gain of over 1 crore, is it possible to avoid Indian tax as the NRI and wants to take his money abroad?
A number of countries have DTAs with India where India does not put any tax on those countries. So UAE is a prime example. Singapore, Mauritius, Oman, I don't know. You'll have to check the DTA.
So next is what is the advantage using GIFT versus FOF by Indian mutual funds? As I saw your post, as some FOFs are open to new investments now.
Yeah, so they are open now. How long they will be open is anyone's guess, because as I said, the limits are very small. Even if you ask the AMC CEOs, Radhika Gupta herself tweeted, very, very small limits left. So you might be able to invest now a bit of a lump sum, but if you want to do let's say a 6-month SIP, will it remain open for 6 months? I have my doubts.
So next is, can you please let me know how to start investments in foreign country? I have heard that if I invest via GIFT, I have to invest a large sum of money. Even $5,000 is too high. But if I invest via IndMoney app, it can be very less.
Yes, that is currently true. But the benefit of Gift City is manifold. So number one, it's a familiar name. Ultimately, IndMoney has a tie-up with Drive Wealth, which is US broker, which means your assets are in the US. There's a threat of US estate tax at some point, etc. Gift City is under Indian regulator IFSCA, and any entity operating there is under that regulator, governed, accountable to it. And tax-wise, it's inside India, so there's much less compliance from a Schedule FA point of view.
So next is, I also heard that via Gift City, I can only invest at minimum of 1 share, but via US broker, I can invest in fraction, which is the best option to invest outside India.
Yes, that is true when you compare a Gift City fund with current. So you have to remember the timeline here, right? A lot of these apps in Money Vested began at a time when Gift City was still being built out. It was not present. So these things will quickly emerge in Gift City. Especially watch out for what India NX is offering, which is the BSC wala exchange. uh, rather than going through a. I mean, the brokers are fine, but in general, try to go for conflict-free platforms as much as you can.
Yeah. So next is Neil. Could you please post a link to the UCITS ETF that get listed in Europe? Does that mean it will need to be invested in euros and keep to diversify into a euro-based investments as I'm already invested in USD?
Uh, okay, so let me get back to you on that. From what I understand, euro may not be necessary. But we'll do a detailed post on how to invest in a UCITS ETFs and which are the common UCITS ETFs. I'll make a note of it.
So next is what is the process of investing in foreign REITs and InvITs?
You can invest in them if you have a broking account in the US through, like I said, either Interactive Brokers, Vested, IndMoney, PSC wala, India NX. There are a whole bunch of REITs and InvITs that invest in US real estate or real estate across the world. But do you really want to get into that complication is a question. Maybe if you have a strong view on real estate, yes.
So next is Parag Paref density fund the retail minimum ticket size? It's not yet launched.
It's in beta phase, so unfortunately I can't say much about it right now.
So next is as a Europe-based NRI planning to retire in India after 10 years, is it recommended to invest via Gift City, outbound, US or Europe or East Asia, or invest directly from a service provider based in Europe?
From a convenience point of view, it might be easier for you to invest through a European service provider. Um, if you intend to come to India really soon, then maybe Gift City is an equally good option. It will not affect. I mean, changing back to Indian resident is not going to affect your outbound fund. Like I said, inbound is something that we have to get back to you on.
So last question from Anudeep. Can any retail investor participate in BSE International Exchange? If yes, how?
Yes, you can. Just like you would open an account on in Money or Vested Finance, you can do it on India INX. Let me just try and post the link of this website, India INX. Oops, has it done it? No.
Yeah, I think so. Yes. Yeah, you have shared something.
Yeah. Okay. There we go. India INX. There's also an NSC subsidiary. But they are both active. I think BSE is a bit more active in GIFT.
So yes, someone has asked for recording. Yes, our recordings will be live on YouTube very soon. And the last question, I think so. Can you do a story on how to do investment via Gift City with benefit of access of all US stocks, ETFs, along with the fraction shares? INX has all these options.
Yes, it does. And yes, we will do a story on it. Couple of people have raised their hands for a long time, so maybe we can have one or two just in-person questions and we'll close.
Yeah. So
Himanshu has his hand up.
let me figure out.
Yeah, I got my question answered. I couldn't find the Q&A actually. Thanks a lot anyways.
Cool.
Yeah.
Thanks so much. Manideep, you want to quickly ask your question?
Now you'll have to unmute yourself.
Okay. So I think on that note, we can probably close. Guys, thank you so much for attending. I'm sure there's a lot more to discuss and to discover. And we are also in the process of learning about Gift City. So feel free to tag me on social media at any point of time with any questions, feedback, comments. And yeah, let's see this very, very interesting story unfold together. Thank you, everyone.
Thank you. Thank you, Neil.
Thank you, Neil. Thanks a lot.
Thank you.